Good morning, traders. It's a pleasure to speak with you today, especially given how dynamic and unpredictable the world of Forex can be. I'm Erica Trina, your host from Sen Securities. As many of you know, understanding past events is crucial to navigating the volatility and opportunities that exist in our markets. Today, I'd like to take you back to one of the most significant financial episodes of modern history, the Asian financial crisis of 1997. This crisis didn't just affect Asia, it rippled through global markets, reshaped economic policies, and offered lessons that are still relevant to traders and investors today. Let's explore what happened, why it happened, and how it impacted the world. The Asian financial crisis erupted in the summer of 1997, starting in Thailand before spreading like wildfire across East Asia and beyond. It was a wake-up call for market participants, exposing the fragility of economies that had, for years, appeared to be models of growth and development. For many years leading up to the crisis, Southeast Asian economies like Thailand, Indonesia, Malaysia, and South Korea had been enjoying rapid expansion. These economies were growing at impressive rates, attracting foreign capital at unprecedented levels. Investors, encouraged by the stability provided by their pegged exchange rates and high returns, poured money into these countries. Now, on the surface, everything seemed golden. These economies were often referred to as tigers for their roaring growth. They had strong export sectors, booming real estate markets, and vibrant industries. But beneath that sheen of prosperity, there were significant vulnerabilities. One of the biggest issues was the way these countries financed their growth. Much of it was fueled by foreign debt, short-term loans in foreign currencies, especially the US dollar. Banks and corporations in these countries took on massive amounts of debt, thinking that as long as their currencies remained stable and their growth continued, they could easily service their obligations. But here's where the danger started to creep in. These economies were reliant on fixed or semi-fixed exchange rates, pegging their currencies to the US dollar or a basket of major currencies. This exchange rate policy was designed to provide a sense of stability and predictability to foreign investors. However, the downside of this system was that it limited the ability of these governments to respond to economic pressures, particularly when external conditions began to change. For example, in the mid-1990s, US interest rates began to rise, which strengthened the dollar. Suddenly, the debt that these countries had taken on in dollars became more expensive to service. Combine that with signs of overheating economies like rising inflation and speculative bubbles in real estate, and the situation started to look precarious. Then came July 1997, and Thailand became ground zero for the crisis. The Thai baht, under heavy pressure from speculative attacks, couldn't hold its peg to the dollar any longer. The Thai government had been spending vast amounts of its foreign exchange reserves to defend the baht, but by July, those reserves were nearly depleted. So, on July 2, 1997, the Thai authorities threw in the towel and allowed the baht to float freely. The result? A sharp and sudden devaluation. The baht lost over half its value in the ensuing months, triggering panic among investors. Once Thailand's currency collapsed, fear spread rapidly across the region. Investors began to question whether other countries in the region were facing similar problems. Indonesia, Malaysia, South Korea, these countries all came under speculative attack, with investors pulling out their money and placing intense downward pressure on their currencies. Stock markets in these countries plummeted, and their currencies lost significant value. The Indonesian rupiah, for instance, saw one of the most dramatic collapses, losing over 80% of its value at one point during the crisis. But the currency collapse was just the beginning of the crisis. As local currencies plunged, banks and corporations that had taken on massive amounts of foreign debt were suddenly faced with a debt burden that was spiraling out of control. Imagine borrowing in dollars, expecting to pay back with stable local currency revenues, only to see your local currency lose half or more of its value. That's exactly what happened to many businesses and financial institutions across the region. It quickly became clear that many of these loans were never going to be repaid. The fallout was particularly severe in Indonesia. The rupiah's collapse led to a full-blown financial and economic crisis. Indonesia's banking system was particularly fragile, with many banks holding large amounts of bad loans tied to politically connected businesses. When the currency fell, these banks found themselves unable to repay their foreign obligations. The result was a wave of bank failures, a collapse in investor confidence, and ultimately, a political crisis that led to the downfall of President Suharto after more than 3 decades in power. South Korea, another major economy affected by the crisis, was also brought to its knees. South Korea's corporate sector was dominated by large conglomerates, known as chaebols, which had borrowed heavily from international lenders to finance their rapid expansion. Much of this borrowing was short-term and dollar-denominated, which left them highly vulnerable to currency fluctuations. When the South Korean won began to depreciate, these debts quickly became unsustainable. South Korea was forced to seek a bailout from the International Monetary Fund, IMF, in December 1997 to avoid a complete economic collapse. It wasn't just Thailand, Indonesia, and South Korea that were affected. Malaysia and the Philippines also experienced sharp declines in their currencies and stock markets. Malaysia, in particular, took a unique approach to dealing with the crisis. Instead of turning to the IMF for assistance, the Malaysian government under Prime Minister Mahathir Mohamad decided to impose strict capital controls and abandon the ringgit's peg to the dollar. This was a controversial move at the time, but it ultimately helped stabilize the country's financial system and protect it from further speculative attacks. In the broader picture, the International Monetary Fund played a central role in managing the crisis, especially in countries like Thailand, Indonesia, and South Korea. The IMF provided emergency loans to these countries in exchange for economic reforms, which often included harsh austerity measures, higher interest rates, and significant restructuring of their banking systems. These reforms were intended to stabilize the currencies, restore confidence, and prevent the economies from completely collapsing. However, these IMF programs were highly controversial. Critics argued that the IMF's insistence on austerity measures and higher interest rates worsened the economic downturns in these countries, leading to deep recessions and social unrest. Unemployment spiked, poverty rates increased, and in some cases, protests and riots broke out. The social and political costs of these reforms were high, and the IMF's role in the crisis remains a subject of debate to this day. In addition to the IMF, other international organizations and governments also got involved in the efforts to manage the crisis. The World Bank stepped in with financial assistance aimed at supporting infrastructure projects and social programs, particularly in countries like Indonesia, where the crisis had caused severe social dislocation. Meanwhile, the United States and other members of the G7 provided backing to the IMF's efforts, understanding that the stability of the global financial system was at stake. The Asian financial crisis had far-reaching consequences for global markets. The immediate aftermath of the crisis saw sharp declines in stock markets around the world. Investor confidence was shaken, not just in Asia, but in emerging markets globally. The crisis led to a significant rethinking of the risks associated with investing in emerging markets. Many investors, who had previously viewed these economies as safe and profitable places to park their capital, became much more cautious. Capital flows to developing countries slowed dramatically in the years following the crisis, and emerging markets experienced a sharp decline in growth. For forex traders, the crisis highlighted the risks associated with fixed exchange rate regimes. The collapse of the baht, the rupiah, the won, and other currencies showed just how vulnerable these currencies were to speculative attacks, especially when governments were trying to defend unrealistic pegs. The lessons from this crisis prompted many countries to move toward more flexible exchange rate regimes, which allowed their currencies to better reflect market forces and gave governments more flexibility to respond to economic shocks. One of the key long-term effects of the Asian financial crisis was the push for economic and financial reforms in the affected countries. In South Korea, for example, the crisis led to significant reforms aimed at strengthening the banking sector, improving corporate governance, and reducing the dominance of the chaebols. Thailand and Indonesia also undertook reforms aimed at improving financial regulation and transparency. These reforms helped stabilize the economies and reduce the risks of future crises. On a broader level, the crisis prompted a rethinking of global financial architecture. Policymakers around the world recognized the need for stronger international financial regulation to prevent future crises. While some reforms were implemented at the international level, such as stronger IMF surveillance and better coordination among central banks, many of the more ambitious proposals for global financial governance did not materialize. However, the crisis did leave a lasting impact on how investors and policymakers view emerging markets, financial regulation, and the role of international institutions in managing economic crises. In the end, the Asian financial crisis was a profound reminder of the importance of sound economic policies, prudent financial regulation, and the risks associated with excessive reliance on foreign capital. For forex traders, the crisis underscored the importance of staying alert to macroeconomic conditions and the vulnerabilities that can emerge when governments try to maintain fixed exchange rate regimes in the face of changing global conditions. So, as market participants, the lessons from the Asian financial crisis remain relevant today. Whether you're trading in currencies, stocks, or bonds, it's essential to understand the dynamics of global markets, the impact of monetary policies, and the risks that come with rapid economic expansion. The 1997 crisis may be over, but its lessons still echo in the financial world, offering guidance on how to navigate the complexities of today's interconnected markets. Thank you for your time, and I hope this look back at the Asian financial crisis provides some valuable insights for your trading strategies going forward. Always remember to trade wisely. Thank you.